or a rework or a restructure or something, there's nobody at the other end of the phone. And I think that's the servicers that are out there now, and there's only 3 or 4 that are handling the bulk of the activity, are overwhelmed with the problems that they have. And that's part of, you know, when you were hearing to the debt restructuring folks, part of the problem is that stuff just isn't coming out. It's not getting unlocked because it's constipated, frankly, on the servicing side. And so, you know, I think all of that is, you know, hopefully getting weaved into the new version of CMBS, but in a lot of ways the new version of the CMBS is looking like the old version of the CMBS. And we'll just have to see how that plays out.
I think that was a great explanation. I would only add a couple of points to it, which is when CMBS itself and the structure, it's not really the problem. It's the implementation of the structure. The structure is a good thing. It's taking an investment and it's positioning it very tightly to people who want certain aspects of it. Makes it economically more efficient. Having the CMBS market, having the RMBS market have really accelerated real estate in this country and all throughout the world. When you think about it's an immature market. We're talking about a market that's 25 years old, and it's a market where they haven't ironed out all the kinks. But if you think about what it's done, it's really led to a huge amount of economic development, which I think is net a positive thing. It's been abused. The structure has been abused. The legal aspects of it haven't been totally figured out. But I think we need to figure it out very quickly because, as you mentioned, there's $250 plus or minus $1 million were underwritten at the peak of the market for each of 3 or 4 years. And as that follows through, we're going to either need to refinance that, or we're going to see a flood of commercial properties coming back on the market, which is going to kill pricing. And that's going to be a big problem. So we don't have a huge amount of time to get it figured out.
Yeah, the one thing I wanted to add, the reason why everybody talks about CMBS, at the height of the market, 1/3 of every commercial real estate, 1/3 of the commercial real estate loans that were financed in this country were financed by CMBS. So it's a huge part of the market. Now that percentage has fallen over the last couple of years because the amount of CMBS being issued has fallen, but it's still 20% of the total financing market for commercial real estate, and it's the most transparent of all the financing that's being done. So there's a lot of statistics. So that's the reason you read a lot about the CMBS market, because there's lots of data that's actually floating around out there.
Great. And Scott, just a follow-up question to that, and to use your term, XLAC, what do you think is going to be the thing that breaks the log jam and gets the capital flowing again and gets the properties out there? And who do you think is going to end up taking the hit for some of those write-downs?
Well, certainly the fact the CMBS market is coming back is being helpful. Life companies right now are issuing the most financing out of anybody. The larger banks coming back into play will be a very important source of potential financing. One thing that we haven't really heard today is the issue that's really occurring at the smaller kind of regional and community banks, and a lot of real estate loans are made at those entities. And those are the guys right now who are under pressure. They're under pressure from the regulators. In some cases, 50, 60, 70% of their assets are commercial real estate loans, and they haven't been dealt with. And that's a concern that I have, is what's going to replace those guys. Because the little local developer, that's where he's getting his financing. It's not going to the CMBS market, and it's not going to a Wells Fargo or one of the big money center banks. They're going to the local community banks, and that's where the next round of issues are going to be. And having been out and talked to the federal regulators, they're really struggling right now with how they're going to deal with this. Because if they really start pushing the smaller banks who have these big commercial real estate portfolios, they start pushing them to restructure, they're liable to push those banks over the edge. And so the number of banks that are going to be shut down or taken over by the FDIC potentially could grow exponentially. And that obviously has implications for the larger economy. So I'd say CMBS is going to be a good source of potential new income or new financing. Certainly the larger banks. We're seeing a lot of overseas entities coming in and lending on U.S. properties because they think it's still a safe harbor for them in terms of an investment. So, but we still have this kind of lingering issue in the background with the community and smaller regional banks.
Great. So as it relates to that, and this question is for you, Jason, I would imagine that as we have the bifurcated market, bigger deals, bigger banks, there's the smaller players, and people in that group will sort of go back to probably the private equity with the old waterfall structure. Can you talk a little bit about where you see that headed?
Yeah, absolutely. The rates that we've seen pre and post recession, we have seen an impact to the market rates. And prior to 07, 08, 2 and 20 was a general rule of thumb for the hedge fund and private equity space. And in the real estate space, our experience and the conversations we've had with our peers, 1.5, and hurdles that are 15 over an 8 are pretty common these days. So that was quite a dramatic drop. What we're also seeing now is, just as Amanda was saying, a bifurcated deployment of capital. What we're seeing is large allocators have a strong preference for single country, single property type groups, and a lot of them have a predilection for core. Whereas the smaller and mid-size allocators, they are open for commingled closed-end and open-end structures, but today we are seeing a minority of them interested in that model. It really is shifting into this version of large allocators gunning for separate accounts.
Great. And so, I don't know if you think that will directly affect the REITs obviously were the first ones to come out of the recovery. Do you think that was part of the reason for that recovery so quickly, or people flocking to the public arena as opposed to?
Well, I think what they realized when they could short the REITs as quickly as they could is that, wow, this is a vehicle that's real estate and it's actually liquid. And we suffered through the liquidity on the downturn, and then they said, this stuff is priced way under replacement cost, way under any rational value, and these companies, for the most part, are going to survive. So then we became magnets for capital, and a huge amount of capital came into the REIT market, positioning those companies with liquidity for what we all thought was going to be this onslaught of distress. But then the banking system, as we heard earlier this morning, has not turned over distressed assets as quickly as expected, and so REITs are now sitting there very liquid, thinking about what they're going to do to show growth. Because it was a nice thing to fix the balance sheet, but that's what you did for me last year. Now what are you going to do for me next year? And we have a lot of companies that are sitting out there with good balance sheets that are very hungry to do deals, but the deals just are not materializing. Used to be nobody knew where pricing was. Now people are a little more certain about pricing, but they're not getting the assets that they thought were going to come to market. I don't know if you have similar thoughts.
Yeah, I think that the challenge was that every buyer of distress was looking for a 20% rate of return, and there are not many people that like to sell at 20% rate of return. 20% rates of return are pretty nice, particularly when you have a quarter point LIBOR and a 2.5% Treasury. By that measure, a 5% dividend on a REIT looks really good too. And so I think that that it's not just a function of the banks or the servicers not willing to put stuff out. It's just they're not willing to put stuff out at what a distressed buyer is willing to pay. And so there has been a bid-ask in this business for a couple years. And I think the bid-ask still exists to a certain point, and it only to the degree that the equity guys who are sitting on money and either have to use it or lose it, are they going to start to adjust their return expectations? Either that or their Excel spreadsheets are going to get a little better at producing the right result.
And I can tell you, on restructuring of deals where an existing borrower is putting in new equity, the idea that they're going to get a 15 or an 18% return on new equity that they're putting into an existing deal, it just doesn't happen. I work with borrowers at the time and helping them restructure debt, and the banks start at 12 on any new equity that's coming into an existing deal. This is for a borrower who's trying to restructure the debt, and they are not going above that number. So the idea that any new equity is going to come in and get 15, 18, 20% on an existing deal, it's just not gonna happen.
So what are we to do with all the capital then that's been sitting around? What will happen? I mean, companies like Mind Colony, we have money, we're ready to invest. What will companies do with that capital? And how will that impact the market?
Well, I can tell you that one of the ideas that we're pursuing with a lot of our equity fund clients is direct investment in banks. So if you can't buy the assets, if the banks aren't actually putting up the assets for sale, is there a way that we can inject money into banks that need the capital into some type of structure? It's similar to a joint venture, or maybe kind of a throwback to the old good bank, bad bank, where the bank throws in their all of their distressed assets in a pool, and a new entity actually comes in through some subsidiary or some type of structure, and is able to get at the assets that way. So rather than being kind of offered on a one-off basis on an open market or selling a portfolio of loans, let's go directly and invest in the banks. And we've been working with regulators and on tax issues and accounting issues and what have you, so that our equity fund clients can actually do a structure similar to that. And that may be a way of starting to clear some of the assets without the banks having to write them down, especially at the community and regional level where they can't really afford to do that.
And so just, do you have a?
Well, I was going to offer you an A or a B. I mean, either we're going to see that there's a ton of money that fills this equity gap, because if you look at a couple of years, you see $150 to $200 billion of required capital to refinance the CMBS maturities. Let's say that there's 50 of that's coming out of the new CMBS market. Let's say that there's 50 coming from other sources. There's still a huge gap. Some of that's a write-off, and some of that's equity that's going to be sucked out of other vehicles and flow into that marketplace. If not, there's going to be huge pressure on the REITs, at least, to start buying their own stock and doing other things to reposition the capital, because if they can't use it, nobody's going to want to sit and see them holding on to it.
So the follow-up question, we talked a lot about the importance of the core, the A properties. And one of the things that we were talking about is the things that are left on the market at this point in time are the B and the C, tertiary markets. And does it beg the question that if there's capital that needs to be spent, and then there's all the trophy properties have been bought, will companies go back into the B and C markets? Will there be a way to justify that? And if so, what kind of returns do you think they'd need to trade off for that?
Yeah, I think there's as it always happens, the first recoveries happen in the prime markets with the prime properties, and that so that the cap rate gap, if you will, between what you get if you buy a prime multifamily property in Boston versus what you pay for a prime multifamily property in Louisville, just to pick it's not going to be double after a while. Somebody's going to say, well, that 12 looks pretty conservative, looks pretty safe. I'll go. I may have to put more equity in because the same amount of debt's not available because the lenders are also the same breed of cattle. They're all going to go to the core properties and the core markets first, and go into the particularly if capital's constrained, they're not going to rush to places where it's harder to get your money back out. But that it will happen. You'll start to see people turning to the Bs. We talked earlier. 20% rates of return on equity you're not going to get from financial engineering. You're going to get 20% rates of return by working real estate, adding value, buying a property, converting it, turning it around, re-tenanting it, repositioning it. And those opportunities are going to exist in multiple markets. And I think people will start turning to the tertiary markets, to the suburban markets, because a 5% rate of return on a well-located apartment property in an urban location isn't going to look so great against a 3.5 treasury or 4 treasury. I mean, there is risk to that portfolio, and you do have to continue to invest money in commercial real estate. So it will take some time to get to that point, but absolutely, I think we'll see some recovery in those. I just don't think it's today.
And you're starting to see that in terms of asset classes, because a year ago, if you ask everybody where they wanted to invest, they wanted to invest in apartments, because the demographics look great. There's no new construction going on there. In the last 6 months, the hottest asset class right now, and I can tell you, we get calls every day looking for hotels, which are very risky assets and tend to go up and down as quick as the economy does. But everybody's looking at hotels because the returns are going to be better there. So you're going to start seeing that drifting